For years, you have been diligently saving your money. Now, your savings amount is quite big. You want your monies to grow faster and decided that the best way to do so is to invest them in a unit trust scheme. As you do your studies about unit trust investments, you discovered something known as loan financing and how it can help enhance your investment. So, what is loan financing? Essentially, loan financing is when you borrow money from a financial institution and use that money to supplement your investment. Before you opt for loan financing, there are factors that you must consider seriously. Among them, the loan interest rate, the monthly loan repayment amount, the unit trust scheme's income distribution rate, and the unit trust scheme's price fluctuations. Also, consider whether you are willing to be exposed to the credit risk associated with using loans. When you take a loan, you will have to pay it back. However, the repayment amount will actually be higher than the amount you borrowed. This is because the bank will charge you interest on the loan. The interest rate will not be the same throughout the loan period. It will fluctuate, potentially causing you to pay higher monthly installments. As such, using loan financing will expose you to interest rate risk. There are two aspects to this. Paying installment payments on your loan financing, including the interest payments, is guaranteed. However, distribution payments from investing is not guaranteed. Hence, in the event no distribution payment is made, you will still have to pay your loan installments. Additionally, even if the unit trust scheme pays distribution, in order for your investment to be profitable, the distribution rate must be above your loan financing interest rate. If it isn't, you will have to pay for the shortfall. The second aspect is in relation to the movement of the unit trust scheme's unit price. Let's say when you invested in the unit trust scheme, the unit price was 1 ringgit. If the price increases to 1 ringgit and 10 cents, you make a 10% return. If the price had decreased to 90 cents instead, you will make a 10% loss. Usually, when the bank provides loan financing, they will ask for a collateral. Should you fail to pay your loan installments, the bank can take possession of the collateral and sell it in order to recover your loan amount. In loan financing, oftentimes, the collateral will be the units you hold in the unit trust scheme. As such, if you fail to make the installment payments, the bank can sell your units and you can lose your investment. Since your units are used as collateral, it is in everyone's interest that the unit price either remains the same or the unit price increases. If the unit price falls, this means that the value of your investment and, by extension, the value of the bank's collateral also falls. If this happens, the bank may require you to pay more in your installment payments to cover the shortfall in value. Also, consider the impact of distribution payments on your investment. When a fund pays distribution, the fund's price will fall in proportion to the distribution amount. This may impact the value of your investment and, by extension, the bank's collateral, especially if the distribution amount is not reinvested. Additionally, when making distribution payments, the fund may incur some operational costs, and this may also impact the value of your investment and of the bank's collateral. As such, even though the potential investment returns are high, the risk of investment losses is also high. That is why, if you want to use loan financing, you need to manage the risk very well. Some steps that you can do include search for the best loan deal. Lower interest rates mean lower installment payments. Consider all the other obligations the bank attaches to the loan. Make sure you are able to pay the loan installments. The higher the amount you borrow, the greater the amount of your installment payments. Hence, Being able to service the loan on time is crucial. Don't use the distribution payments to pay your loan installment. If you keep the distribution payments received in the unit trust scheme, the compounding effect will generate greater returns in the long term. Set aside an emergency cash fund. By having money readily available, this will help you make the necessary payments in the event of difficulties, such as when you have to top up your installment payments due to decreasing unit price. All investments have risk, and by taking the necessary steps to manage the risk, we can protect ourselves and our investments better from suffering major losses.